It's been quite a ride for equity markets this year. Uncertainty and volatility hit a fever pitch in the weeks following President Trump's sweeping tariff announcement in April, as investors feared the potential for rising inflation, slow economic growth, and U.S. assets losing their aura of dominance.
We've had a number of trade deals get struck and a number more in progress. And so uncertainty has come down, and with it, the market has recovered. And we've been saying, stick with equities. Don't exit the market. Stay with your strategy. It doesn't stay uncertain forever. And once you have certainty, almost no matter what the certainty is, it's good for equities.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Coming up, Tony DeSpirito, Global CIO for BlackRock's Fundamental Equities Group, joins me to help make sense of recent market turmoil from an equity perspective, where he sees opportunities amidst the volatility, and what history tells us to expect as we look ahead to the rest of the year. Tony, thank you so much for joining us on The Bid.
It's great to be here again, Oscar.
And Tony, you were here in January. We were talking about your outlook on the stock market for the year. Animal spirits were high. People were optimistic on the economy. I remember you saying that stocks had been up more than 20% for consecutive years, and that it was rare for it to happen 3 years in a row. And it looks like your viewpoint on that is correct, because we've had a lot of volatility this year. We've had announcements around tariffs that caused stocks to pull back. We've now seen a rally that has seemed to kind of get us back to where we were at the beginning of the year. So tell us a little bit about what you're observing and what's going to cause markets to stabilize.
Sure. Well, without a doubt, there was a lot of optimism at the beginning of the year. And that's how you get 2 years of 20% plus in a row, right? Optimism. And there was a decent amount to be optimistic about. I mean, if you looked at, consumer balance sheets were really strong going into the year, still are. That's result of both strong house prices as well as financial assets. And of course, that provides a good macro backdrop for the markets because there's a lot of cash on the sidelines waiting to get in, right? So that's always a good thing. And then corporate balance sheets are in pretty good shape as well. So no real big excesses there. And then you look at kind of earnings growth is still quite healthy. So that's the positives. The only concern I would have had at the beginning of the year was really around valuation. Valuations are high by historical standards, and that was certainly true at the beginning of the year. And then we've gotten a lot of uncertainty around policy. So if you look at any kind of policy uncertainty index, that's sort of been off the charts this year, and it's all related to trade. And so we had a market drawdown. And if you look peak to trough, that was about 17%. But if you think about what's happened subsequently is we kind of had peak uncertainty. And then since then, we've had a number of trade deals get struck and a number more in progress. And so uncertainty has come down, and with it, the market has recovered. And we've been saying, stick with equities. Don't exit the market. Stay with your strategy. And the reason behind that is if you think about policy uncertainty, eventually you get certainty. It doesn't stay uncertain forever. And once you have certainty, almost no matter what the certainty is, it's good for equities in the sense that corporations can then adapt themselves to that new reality. And then you see earnings go up and you see stock prices go up with it. And that's what we've seen subsequently is that the markets have generally recovered. So if you kind of looked point to point, it almost looked like nothing happened. But obviously there's been a lot of volatility in between.
And when we zoom out many years from now and look at these few months, it will look like nothing have happened. But of course, the day-to-day has felt very different. As you've described, markets have been whipsawed between sort of good news and bad news. And Tony, when you and I talk, one of the things that I always find interesting is that you have these interesting historical anecdotes. You're able to kind of go back and look at some data points from the past and tie it to what's going on in markets today. So what does history tell us about the recent volatility and the market events that have been going on?
Yeah, so history is pretty clear on this, actually. If you look over the last, call it 35 years, go back to 1990 and look at the average drawdown in any given year, it averages roughly 14%. So this year we had a 17% drawdown peak to trough. I'd say that's right in line with historical averages. So really, from the historical scheme of things, no big deal. It obviously felt like a big deal, but it really wasn't when you look at it from a historical point of view. The other interesting thing is if you look historically, buying dips has been pretty profitable. In fact, we went back all the way to the 1930s and looked at data. What happens when you buy on a dip of 20% or more? We use 20% as the cutoff. And it's pretty interesting. On average, if you look 1 year later, so if you buy at exactly the 20% dip, even if it goes lower, 1 year later, on average, you have returns of 15% positive. So that's healthy relative to historical averages. What's really interesting is the hit rate. 73% of the time, the returns were positive 1 year later. And if you extend that time horizon out to 3 years, you actually get to over 90% hit rate on positive returns. And so I think that tells you in general, you want to have a bias towards buying the dips. Now, when might you be more hesitant to buy the dips? Historically, if you look back, it's when there have been big dislocations in the economy. Think about like the global financial crisis where consumer balance sheets were extremely levered, right? That's an example of where you might want to be more hesitant in buying the dips, where things can be the downturn can be more bigger and more protracted. But again, go back to what we experienced this year. Consumer balance sheets are healthy. Corporate balance sheets are healthy. I think everything told you this would be a good dip buying opportunity.
And it's fascinating. You mentioned going back and looking at the 20% pullbacks in markets, which is higher than a historical average. But that number, when we hit 20% drawdowns, the media and the press and the narrative starts to talk about how we're in a bear market. I think 20% is usually when we denote that as a bear market. So it requires a certain level of courage to be able to invest at that time. But what you're saying is that it has been rewarded if you've come in at that time period.
Exactly. And that's why we chose the 20%, because it's what commonly people think of as the bear market. 10% is a correction, 20% is a bear market. And so that's why we use that particular marker.
Tony, you recently published an equity market outlook for the second quarter of the year. I just want to read a couple things that you wrote in there, which is volatility can present great opportunity and dispersion is an active investor's friend. So talk to us a little bit about where are you finding the opportunities right now as an active investor?
Yeah, and I think it's an important point that I want to emphasize because our job as active investors is really to take advantage of dispersion, to take advantage of volatility. That's what we do. And I kind of think of active returns as a function of both skill set and the opportunity set. And the way I measure the opportunity set is volatility and dispersion. In fact, I think the hardest time for active managers is when there's very limited volatility, very limited dispersion. So I think really that period after the global financial crisis, from the end of the global financial crisis through to COVID, was a period of actually very low volatility. The market went up quite nicely, actually. Returns were about double historical averages with less volatility. So there was an easy answer, just buy cheap beta. But since COVID, markets have been more volatile, and that's actually made things much more interesting for active investors. So obviously, we've had a lot of uncertainty around trade and trade policy. So I think that's been certainly an area. But as I look forward, I think there's more policy to come. Tax, for example, that'll present some winners and losers, and that'll create opportunities for active managers. Deregulation, I think that's a real opportunity, particularly for large banks. We're just getting the people in place who are responsible for that, and I do think people is policy, and so we should see that coming shortly. Obviously, that'll have impacts on capital ratios, but it'll go beyond that. It'll go into planning for these large banks. We'll have more transparency around the stress tests, around CCAR. I think that'll be good. There could also be a cost-cutting opportunity there. In the sense that there's a lot of spending, a lot of costs that go involved with compliance. If those costs can come down, that'll be really beneficial for banks. So I see a lot of opportunity there, for example.
And one of the other things that you touched on when we spoke in January was this opportunity in large cap value stocks, that you thought this was an area that maybe had some performance embedded within it. And we've seen these stocks have a good run this year. Remind us again, when you say value stocks, what that means and what is the role that they play in uncertain markets like these?
So in terms of value, I think about stocks that are statistically cheap on average, low PE, low price to book, et cetera. And obviously, as an active manager, how you implement that differs from other active managers. Because sometimes I think value, price is what you pay, value is what you get. So you really have to measure the value of a company correctly, and that's actually an active exercise. Certainly, year to date, value stocks have done relatively well, but in the historical context, the outperformance of value is pretty small year to date, and so it's not like you've missed the opportunity in value by any means. I think in terms of the opportunity, I think the biggest and easiest opportunity is just think about diversification and resiliency of your portfolio, your overall portfolio. First of all, if you've set certain targets of value and growth within your portfolio over the last several years, growth has outperformed, and that means it's become a larger percentage of your overall portfolio. So there's an opportunity to get that back in line in many client portfolios. So I think that will just add resiliency, will add diversification. But also, it's not just client portfolios, it's the indices themselves, the cap-weighted indices in particular. If you think about the mega cap companies with $1 trillion or more market cap, those all skew heavily towards tech and growth stocks. And so as a result, the S&P 500, you think of it as a core index, but it's actually become more growthy in recent times. And we've done work with our internal risk models to classify companies within the S&P 500 in terms of growth, core, and value. And then we look at the different weightings in growth and value over time. And right now, and by the way, the index always skews a little bit growthy, and that's just the math of PE multiples. Growth stocks have higher PE multiples, and therefore they get a disproportionate weight in the index always. So it's always a little bit growthy. But right now, it's even more skewed towards growth than it was at the peak of the dot-com bubble, believe it or not, right? So what that tells you is if you think you own a core index, you actually own an index that's quite growthy. And so I think there's an opportunity to supplement that with value, which will create more resiliency. So I think that's the real case for active within value. And I think we saw the importance of having value in your portfolio year to date, right, as a real diversifier. I'm particularly fond of mixing value and quality. When you think about a margin of safety, how do you get a margin of safety? Well, one way you can do that is through quality. Companies that have more steady earning streams, companies that have healthy balance sheets, strong balance sheets, companies that pay dividends, right? Dividend-paying stocks tend to hold up better in down markets. Certainly, this year was no different there. The other way to create a margin of safety is through valuation. If you pay a low multiple, there's just less downside risk in general. Combining the two, it's really powerful and can be really a great way to create more resiliency in your whole portfolio.
And you talked about how, over the last couple of years, there's been volatility in the market, that the growth stocks in the market have tended to outperform. And so even if somebody was holding their portfolio and did nothing, there's an opportunity to kind of relook at value stocks and maybe rebalance towards some of these areas that have been doing a little bit better this year.
Exactly.
And Tony, we talked about tariffs, and we've been talking about tariffs for a while now over the last couple of months. It's certainly not the only issue that investors or equity investors are thinking about. What are some of the other things that you think they should be thinking about, or that you're thinking about for the outlook?
Well, without a doubt, over the long run, the most important thing to be watching is earnings, because it's earnings that ultimately drive stock prices. Sure, in the short run, it's going to be about valuations, it's going to be about factors, it's going to be about the news of the day. But in the long run, it's all about earnings and earnings power. So you always got to keep your eye on the prize, which is focus on earnings. Certainly, we've talked about this a little bit from a policy perspective. Trade's not done. So it's not completely off the table. There's still a lot of deals to be negotiated. There's a lot of pauses, for example. And so stay tuned is what I'd say there. Obviously, the tax bill is going to be a huge deal over the next several months. And then, like I said, deregulation. So there's still plenty to be watching. But again, the real focus should be on earnings.
Another thing that comes to mind when we sat down in January, which really wasn't that long ago, but a lot has happened. But when we came into the year, the U.S. equity market had been the dominant outperformer for many years. And there was a lot of skepticism that markets outside the U.S. could outperform. But what in fact we've seen this year is, with some of the policy headlines coming out of the U.S. and some of the uncertainty that's created, we have seen some outperformance from areas like Europe, for example. So Do you think those sorts of trends are going to continue? Are we going to continue to see outperformance from some of the international or ex-US markets?
Well, it's really hard to compare one market to another. It's like comparing apples and oranges. Without a doubt, the US is expensive relative to other markets around the globe. But on the other hand, it's also the highest quality when you think about companies with a lot of innovation, when you think about high levels of profitability, return on invested capital, return of capital to shareholders through dividends, but also buybacks. The US leads the way in buybacks. And so, yes, it's more expensive, but it also has more quality. I think it's a hard comparison to make. And so I tend to think more in terms of apples and oranges when you think about comparing markets. That said, I will point out Japan is kind of an interesting market for investors to look at. Japan has a very low correlation to other markets around the globe. So again, going back to this idea of resiliency and diversification, Japan's always a good diversifier for that reason. But I think it's interesting almost for the opposite reason the US is interesting. The US is interesting because the quality of the companies are so great. If you look at return on invested capital across the globe, the US is about double the world average in terms of return on tangible capital. Japan's at the low end. But that's what makes it interesting is that there's an opportunity for that to improve. And if you look at Japanese corporations, they've really gotten religion with respect to this, both in terms of improving profitability, simplifying their businesses, as well as returning capital to shareholders. And that has just been improving year after year after year in small increments, but it's added up. At the same time, the macro backdrop in Japan looks better. They've gone from multiple years of deflation to now having inflation. But you have this huge potential improvement in corporate profitability. And again, it's a real diversifier because it's so uncorrelated with the rest of the world. So I do think that's an interesting market just to call out. Finally, I prefer, and this is something we do in fundamental equities, it's more comparing apples to apples. So look within a global business like energy or healthcare, and then make comparisons across the globe there and see where the opportunity set lies. Two areas where I think there is interesting opportunities in Europe that I would highlight. One's in energy and one's in pharmaceuticals. If you look at energy companies in the US and in the UK and Europe, there's a pretty big valuation gap, 30–40%. The US is more expensive. And if you look at the quality gap, historically, there has been a big quality gap. There are instances of specific companies where they've been shrinking that quality gap over time. They've been becoming a lot more like the US, more focused on return on capital, et cetera. And so I think that makes for some interesting stock opportunities in the energy space to go abroad. Similarly, in pharmaceuticals, it's similar but different. There, the multiples are pretty close between the US and European pharmaceutical companies. The difference is quality is actually better in Europe in many cases. A lot of that goes to patent expirations. A lot of the US large companies have upcoming patent expirations that the Europeans just have further out in the future. Patent expirations are always tough because your revenue declines and then you have a certain fixity of costs that you have to deal with. So you face some margin compression and then you have to figure out as a company, how do I replace that revenue? Either by spending more on R&D or doing acquisitions, which can be expensive. So I think that puts actually some of the US pharmaceutical companies at a disadvantage to some of the European ones. And then of course, when you think about policy, right, healthcare is certainly in the policy hotspot at the moment. One of the ideas there is most favored nation status, right? Historically, drug prices in the US are a lot higher than they are in the rest of the developed world. One of the goals of the administration is to normalize that, right? Well, that means lower drug price in the US, but it also means maybe higher drug prices in Europe or other parts of the world. And when you look at the global pharmaceutical companies, they are global businesses, but on average, the US ones tend to skew a little bit more towards the US, the European ones a little bit more towards Europe. Well, if you think about drug prices normalizing around the world with the US coming down and European prices going up, that's potentially an opportunity for some of these European companies. So in addition to just not having to deal with the patent expirations, they may have better pricing power over the next couple of years.
So Tony, as we wrap up, one of the things that comes to mind is I always enjoy hearing your words of wisdom for investors. And you've shared some of those already. You've told us that we should focus on earnings. You said price is what you pay, but value is what you get. What else would you say to investors who are trying to navigate the ups and downs of market volatility?
Oscar, I think it's important and helpful to go back to first principles. And so what are you doing when you're buying stocks? Well, you're essentially buying a share of the world's productive capacity. And over time, through innovation, through companies' abilities to do things faster, cheaper, better, over time, that goes up. And that's a great place to be. And yeah, there are setbacks along the way, temporary setbacks that cause volatility. Policy changes, inflation, recessions, even geopolitical conflicts, right? But the general direction is up. And when you think about volatility, sure, stock prices are going to be volatile, earnings less volatile, GDP even less volatile than that. But the direction of travel is up for all of these things. And so when you take that mindset, you really look at volatility differently, and you don't get as worried about short-term volatility, and you keep your eye on the long run. And so one of my favorite expressions is that it's not about trying to time the market, it's about time in the market. And so if you can just extend your horizon, extend your thought process, and stay invested, that's going to be the key to wealth creation over time.
And that actually rhymes with a message that I find myself telling people when they ask me about long-term investing, which is that when you invest in stocks, you're sort of betting on human ingenuity. And I think you used the word innovation. And if you believe that that improves over time, then investing in stocks is potentially a rewarding experience over the long term. So I guess I'm channeling my own inner Tony DeSpirito when I tell people that. Tony, it's always a pleasure to have you on to hear about the equity markets and your outlook. And thank you for doing it here on The Bid.
I love doing it. Thank you, Oscar.
Next up on The Bid, Carrie King will get more granular on equities, discussing the recent earnings season and where savvy investors can look for opportunities during this period of uncertainty. If you've enjoyed this episode and you want to keep up with what's happening in the economy and the latest market trends, make sure to subscribe to The Bid wherever you get your podcasts.